This is called hydraulic fracturing. Here's the ground. Here's a rock formation. There are little bubbles of natural gas in the rock formation. Here's a reservoir of natural gas above the cap rock. Before the 2000s, we couldn't, in any appreciable quantity, access natural gas other than that right there. We had no way to break through the rock to get the smaller deposits that were in individual pockets. 2000s come along, and we discover a new process. It's called hydraulic fracturing. We're going to take a pipe down to the rock. We're going to shoot water at incredibly high pressure along with benzene and a couple lubricating agents, and we are going to make fissures, aka cracks, in the rock. From these cracks, the natural gas is going to flow straight up into our pipe, up to the surface, and we can harvest it. Sorry, my cameraman was giving me some signals there. Anyway, so we're going to harvest the natural gas. And it turns out America has 4 to 5 times more of this gas, which is called shale, than it does that, which is called conventional or tight gas. So, the price of natural gas, because what does that mean? We have 4 or 5 times as much natural gas we can access, therefore 4 or 5 times as much, say it with me, supply. So the price has to go down. Before this happened, it was like 10 or 11 bucks for 1 million BTUs of natural gas. Each barrel of crude oil has 5.4 million BTUs of energy. So before the hydrofracking boom, an equivalent amount of energy in natural gas would cost you roughly $55 if you wanted an equivalent amount of oil and natural gas energy. After, when all that supply came on market, you know where the price of nat gas bottomed out? $2 per million BTUs. And today it's still like 3. Take 2, multiply it times 5.4. What's your answer? Well, your answer should be something around 11. You're saying, well, why does that matter? I'll tell you why that matters. It's an $11 barrel of crude oil. That's like if somebody came up to you and said, hey, you want to buy a gallon of gas for about 65 cents? So that's pretty important. Now remember what kind of oil we need natural gas to burn off and bring on market? We need that natural gas for Alberta tar sands, because you can't just bring it straight out of the ground and send it to a refinery. You need to separate the oil out. So when all of a sudden natural gas only cost $11 for a million BTUs, it got really frickin' economical to pull that stuff out of the ground and burn the oil from the sand. All of a sudden, North America, of all places, underwent an oil boom, where our supply was going like this, at the same time demand was going like that. So it was a complete reversal of this trend. Thus, we get a crash. Most of this rise back up to $100 a barrel was brought on by the Fed printing money, but that's a whole other story. And this decline right here this past winter had a couple of causes. First off, the dollar went on a rally. And when the dollar costs more, the commodities you buy with the dollar cost less. It's the opposite of inflation. Secondly, the Saudi Arabians, the Middle Easterners, saw that we were producing a lot more oil. And if they scaled back on production, if they pulled supply from market just to try to keep the price high in the short term, we would eat up their market share, ramp up our production, and squeeze them out of the entire market. So they said, we're going to produce just as fast. We're not going to slow down. And here's why that's a good strategy if you're them. See this number, 11 bucks? Today it's about $3 for a million BTUs. So that number's more like $19 of initial cost I have to put in to get out that barrel of Western Canadian crude, or if you're in North Dakota, back in shale, because we have the same type of oil in the northern United States. However, if you're in Saudi Arabia, one, you don't have to buy that natural gas because it's already in a form that you can send right to market. 2, you don't have to pay as much for labor. 3, you don't have environmental regulations. In the US, it costs $45 on average to pull a barrel of oil out of the ground. In Saudi Arabia, it costs $5. In Iraq, it costs $10. So when oil's $90 a barrel we're pretty comfortable spending 45 bucks to get it out of the ground and make a $45 profit, bring that supply to market. What happens when it's here, like it was this March, when it's $35 a barrel? This place stops producing oil. That's what happened. So their strategy was, we're going to push the price of oil, price of gasoline so low that American drillers can't compete. They're going to have to lay off their workers. They're going to have to suspend any new exploration activities. They're going to have to close down the wells that they have running right now because the price is too low for them to even make any profit. They're going to take a loss on the oil they're bringing out of the ground. And it's worked to some extent. About 2/3 of the wells that were producing oil in the United States right here are now closed. And that's part of the reason for this little rebound in the price of oil. That's why you saw the price of gasoline go from $1.90, whatever it was, back up to about $2.65. Because supply has come off market. We're starting to hit equilibrium again. So anyway, and the big lesson you can take from this is we really can't predict where it's going. Ideally, according to an economist, oil is a finite resource. Yes, we can agree on this. We're not going to pull out a barrel of oil and boom, spontaneously it regenerates. Ain't going to happen. So ideally, demand is growing because there are more humans on planet Earth. Supply is going like that, right? Because, you know, there aren't many people consuming oil. So we're pulling out some, but it's going down very slowly. And then there are more people consuming more each. So it's like an inverse relationship. And when this happens right here, prices shoot through the roof. So generally what we should see is just a steady increase in price, theoretically. But that's not what happens because there are bigger forces at play. Supply and demand chase each other and come to equilibrium. Prices don't tend to go way up there or way down there. They tend to kind of equalize around some kind of line because when demand gets too low, prices have to come down, supply goes up, and then, you know, prices are lower, which means demand goes back up, and I don't know, pick a bad 70s song. What goes up must come down. Spinning wheels have got to go round. Anyway, I got on a bad music train of thought there. So the Keystone XL pipeline is supposed to come down through the United States right here from northern Alberta, where they're producing the tar sands, straight down the western Great Plains to Port Austin, Texas, because Port Austin, Texas is a tax-free zone. It's an international trade zone. And that's the reason why the Canadians want to put it there, is because they can export it. Now, not to drive my cameraman crazy, but looking at this chart here, where would they want to export that oil to? Rhetorical, but how about there? Because Europe has $70 a barrel oil. Canada has $55 a barrel oil. It's like diffusion. To draw a science analogy, you know, I've got all these air molecules in here, very few on the outside. They're going to tend to go that way until they equalize. So the Canadians are producing $52 barrel oil. The Europeans are suffering with $70 barrel oil. Part of the reason this is not very expensive, how many people live in Canada? I mean, come on, what, 30, 40 million? It's basically a big expanse of wilderness with a couple of people sprinkled in here and there. There's not a big market to sell it. In Europe, there is. So they want to build the Keystone Pipeline to Texas and export this oil there. Let's say I undercut that oil by $7. This oil, to compete, has to come down to say there. Look what's happening. We're equalizing. Economics at work. So the Keystone Pipeline, even though I'm a libertarian conservative, I don't want to talk about my politics too much on this video that's supposed to be nonpartisan. But the Keystone Pipeline, is it really going to help us achieve energy independence? No. Because if they wanted the oil to stay in North America, they wouldn't build the pipeline Port Austin, Texas. They'd build it to Cushing, Oklahoma, or they'd build it to Memphis, Tennessee, or Indianapolis. They would not be building it here where they can export it without paying taxes. They want to send it to China and Europe. Will it create good paying construction jobs? Sure it will. Are there environmental concerns? Yeah, a couple. But you have to see it for what it is, not what you want to see it as. So the reason we can't take advantage of that hydrofracking boom we have and pay, some of my viewers may be saying right now, you just told me there's a 65-cent gallon of gas out there. Why can't I buy it? It's just in the form of natural gas. Well, sorry to disappoint you, but we're addicted to oil. All of our cars are engineered to run on gasoline. And to undergo natural gas combustion, you need a really, really, really cold, I don't even know if you call it a gas tank anymore, but fuel tank. You need a really cold environment. You need energy to carry that out. Your cars would be really combustible, so there are problems with that. Does anyone see an economic problem with that plan? Maybe if we doubled our consumption of natural gas, the price wouldn't be so low anymore because you're adding demand. I don't know, just call me crazy. Anyway, I alluded earlier to this thing called an API value. It's an American Petroleum Institute value. And yes, they've been around for a while. They're not just the organization you see running all the political commercials. So back in the early 1900s, when we didn't really know how to trade all this stuff yet, there were people bringing bad oil to market that you couldn't really do much with and trying to make money on it. So the American Petroleum Institute organized a system where we can measure how good your oil is. And there's an equation, 141.5, don't ask me where they got these numbers, divided by the relative density of your oil minus 131.5. And the relative density is the density of your oil over the density of water. So 10 is the break-even point. 10 is something that's just suspended in water. It's not floating, it's not sinking. So if we put that into the equation, what do we get? 141.5, because I added that over, equals 141.5 divided by relative density. Times relative density, times relative density. 141.5 RD equals 141.5. It doesn't take Albert Einstein to see that a 1 is going to equal a relative density. Thus, if your oil is less dense than water, like, 0.5 over 1, 141.5 divided by 0.5 would be something like, 283 minus 131.5 would be over 100. Okay, you're never going to see an oil that light. But the higher your API value is when you put it into that equation, the lighter your oil is. The lighter your oil is, the easier it is to refine. And going back to this, the easier it is to refine, the more valuable your oil is. If it's below 10, you found a rock. Whoop-de-doo, nobody cares. If it's 10 to 20, that's like the oil they find in Alberta tar sand type stuff. They call it heavy oil. 20 to 30 is medium. You get 30, 35 and up, then you're getting into the light sweet crude oils, which are really, really good to refine. Already went over that. And then crude oil is distilled because we pump it into a distillation column. And we heat the whole substance, kind of like they separate sand from oil with the Alberta oil thing. And as you get higher in the column, the heat decreases and you get different substances that will condense out of there. So the ones that condense first into a liquid, from gas to liquid. So first off, I suppose I should do an illustration. You don't find oil and then just convert it right into gasoline. There are many different products stored in the oil. Only about 60%, 50 to 60% is usually gasoline. There's the intake pipe. Here's my distillation column. So here comes the raw crude oil. It's probably gone through a couple processes before this, but for all intents and purposes, let's just say it hasn't. We heat it up here so that it's all a gas. It's all just molecules. That's how hot this thing is, thousands of degrees. Now, as you get higher, the temperature decreases as you get higher in the column. So down here, it might be, I don't know exactly what the temperature is, but let's just call it 100 degrees Fahrenheit. That's probably not what it is. At that temperature, the biggest molecules, the biggest carbon chains, because it's all a hydrocarbon, that are like, say, 200 carbons long, imagine there are 200 there, no, I'm not drawing 200 Cs, will condense out into a liquid from a gas, and you shut a valve, you cordon it off from everything else, and you harvest that into a tank here. That first one to fall out is asphalt.